key sell-off today we are seeing in Rivian shares, as overall street's still fairly mixed on this name, but some more downbeat outlook perhaps weighing on sentiment today as we are seeing some substantial weakness. We're down now about 9%.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Morning movers, be the first to find out what's shaping early market action. Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out there.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Next Gen Investing. It's now time for Under 30, and we are looking at Rivian, which is down now 9% on the session. Joining us is George Tillis, Senior Markets Correspondent for the network, for some more insight as to why. So, facing for its largest percentage decrease since December of 2024, George, I mean, seeing, again, some mixed analyst feedback here, as Rivian typically does have more polarized opinions, but we pulled back now about 24% from these recent highs. What's driving today's pressure?
Yeah, I think today we talked about this when the stock was making its most recent run to the upside, and it happened based on some very positive news associated with a few factors. Every time we talk about Rivian, the challenge really is production volume. They seem to be really stuck beneath the between 50 and 60,000 unit volume production. They are scaling up their production accordingly in the next 5 years to over 200,000 vehicles eventually. That has really been the problem for Rivian, because prices have to remain very high to offset low production volume. And we know what prices right now, in terms of affordability, have been challenging. So nonetheless, that's creating a problem for Rivian's profitability as well as their cash burn problem, which is still a problem. If you look at top line sales last year to $5.8 billion, they lost about $3.5 billion. And so essentially, the cash burn is essentially putting pressure on the shares. Now, going back to when we saw the run-up in late 2025, coming into this year, there was some positive elements to Rivian's technology. Essentially, they launched a new AI chip, more in line with their own software, kind of competing with Tesla's robotaxi. They said it was either a $2,500 upfront charge or a $49 a month charge for that service. Now, you have to consider what's happening here in terms of scale compared to Tesla. This is important because I suggest this is the reason why we're seeing some downgrades today from UBS, which is now rating the stock as sell, but they did increase their price target to 15 from 13. Tesla has a production volume of over close to 2 million units. They have been down over the last couple of years, and they've talked about this. They have millions and millions of miles driven in data collection to essentially have the robotaxi or full self-driving software. The challenge for Rivian is that they can launch a software, but it may not necessarily be as scalable or as good as Tesla's full self-driving software because they don't have a history. And Tesla has that history. They have a long-standing history of data collection and, of course, adapting their technology for full self-driving faster. It looks like Tesla, again, this is why the Tesla bulls are still intact with the name, will eventually be licensing that technology to other companies. Maybe in the future they'll license it to manufacturers like Toyota, but maybe even to Rivian. So for what it's worth, Rivian did make some progress in terms of launching their own full self-driving software, But, one would say that it's not necessarily close to where Tesla is just because they don't have longevity. The units that are driving out there, the number of vehicles out there, plus the data collection progress that Tesla has made over the past decade.
Yeah, and I will say that I know they're oftentimes compared, obviously, in different points of their overall profitability journey, but today, a pretty substantial downbeat session, and they're shopping around, but actually, towards the back half of 25, Rivian looked pretty solid, so we'll at least see if we can recover some of today's losses in the coming days, but appreciate it. George Tillis, Senior Markets Correspondent for the network, and that will also do it for Alex and myself for Next Gen Investing for, of course, this Wednesday. We're actually seeing the Russell slightly higher now to close things out. Appreciate you for tuning in. Watch This is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
We're live at the New York Stock Exchange right here on the floor on the corner of Wall and Broad. And we have a big show for you today. We are seeing selling across the board for the major averages. So we're down 2 of 3 trading weeks, but did hit some records recently. Unusual options activity for Taiwan Semi, Intel, Macy's. We'll show you some real trades. Ken Polcari joining me right here at the desk. Kenny always has a lot of energy. I'll talk about the markets, the state of the economy, give us some of his picks. And our panel will dive into the retail sales data that we got, showing what the consumer will and will not be spending on, it seems. In the meantime, we have 2 hours left in the trading day. We do have some down arrows. The S&P is at 6904. What happened to 7,000? We were so close, but nope. Down 60 points here. The NASDAQ 100 down 1.5%. Tech is getting hit hard here. The worst of the bunch. The Dow is down a third of 1%. The small caps are actually squeezing out a gain right there, gaining 0.2% overall. Oil and gold, well, those are both higher. Gold is up $48 an ounce, and oil's at the highest in a few months, 3 months. It's at 61.87 the barrel. The VIX at 17.33. The 10-year bond yield continues to come down. It's moving. I mean, it was just right around 420 yesterday and 419 this morning, and now it's at 414. So keep an eye on that. Bitcoin, 97,000. That has been moving higher. It's very significant to note the recent momentum we've seen in Bitcoin. All right, let's break it all down. Senior markets correspondent Kevin Green joins me now, and we are seeing the biggest laggard easily now in the major averages, and that is all about tech and China.
Yeah, we are getting some news around China here, Nicole. And one of the big headlines this morning actually was the fact that China has now encouraged its own companies in-house to stop purchasing and stop utilizing U.S. as well as Israeli-made cybersecurity platforms, if you will. So this is actually having an impact when it comes to Palo Alto Networks, Fortinet, as well as other companies here. Now, this is due to national security concerns, which is what they are citing. And we are seeing the software names as well as the cybersecurity names move to the downside here. Now, we haven't had a true confirmation as of yet, but it seems like the market is trying to get ahead of this story just a tad bit. And this is just another item that's just on the radar when it comes to China and U.S. trade relations. Is this going to be a barrier for us to try to renew some of the hopes of reducing these barriers into 2026? It seems like it's escalating rather than de-escalating. So you are seeing a lot of these shares moving to the downside. It will have somewhat of a meaningful impact if this is going to be the case moving forward for a lot of these companies when it comes to earnings power and their financials just in general. But the big headline mover here today, which is another reason why, once again, technology just in general has been the key laggard for the S&P 500 as well as the NASDAQ 100.
Yeah, I saw Palo Alto down 1%, Fortinet down 2.5%. I'll also note that NVIDIA is down today about 2%. Also, the concerns about whether or not China would accept the H200 chips, too. I think that's been under some scrutiny. Let's talk about some of the financials. Bank of America, Citi, Wells Fargo, all reported numbers today. Not all bad, but lower stocks right now.
Yeah, we are seeing the buy the rumor, sell the news event when it comes to these financial stocks, especially when we had JP Morgan provide pretty decent earnings yesterday, and that was followed up today with Bank of America, which for the most part actually had a pretty decent earnings announcement. Both the top and bottom line did beat, and their guidance moving forward for the most part was actually in line with the street's expectations. But once again, you are seeing maybe some headwinds, maybe some concerns when it comes to new credit card policies that could actually impact the industry as a whole. If you are looking at maybe some of the weaker names that were reporting today, you could make the case that it was actually Wells Fargo. Wells Fargo did miss on the top line when you're looking at revenue. That was reported at $21.29 billion. Street was looking for $21.6 billion. Now, they did exceed on the adjusted earnings per share, having that come in at $1.76. Street was looking for $1.67, but net interest income was actually a big headwind for them. Now, that might improve if we continue to see the short duration as well as long duration treasury bonds, that spread continuing to widen out. That should actually be a benefit for Wells Fargo here, but you are just seeing this selling event when it comes to the financials. This is kind of par for the course. I mean, the last couple of quarters, we actually did see financials holding up after earnings, but usually we do see a lot of these stocks actually selling off, and a lot of them are actually trading at pretty extreme multiples or premiums compared to their 5-year average.
All right, and as I think about what's going on here, I said we were down 2 of the last 3 trading days. We just hit some records on Monday, 3 of the 4 averages. We have 2 hours left in the trading day. I do see up volume actually exceeding down volume, which I can't believe my eyes when I look up there because it doesn't feel that way necessarily when you look at the major averages. I mean, I just put in the NASDAQ 100 to take a look because really we're seeing tech getting hit so hard. Pretty much every single name is down between 1% and 4% in some of the big names that we follow. What are you looking 2 hours of trading?
Yeah, I mean, you mentioned, we have over 50% of the stocks in the S&P 500 in the green so far. We are seeing a pullback to a key level here. The 6,900 level is going to be key for the S&P 500. And we're basically coming back and retesting the 20-day moving average. Now, if you're kind of looking at it over the last month and a half or so, when we do test it, usually we do get some buyers to try to step in here. But some of the technicals are starting to maybe turn here a tad bit, especially if you're looking at that MACD. It is hinging to the downside. But we are still keeping the overall structure of higher highs as well as higher lows. And Nicole, just keep your eye out on the Mag 7 names. A lot of those stocks are now in close to or are in correction territory. So the 493 is actually holding this market up and keeping us near all-time highs as the Mag 7 is kind of pulling back fairly aggressively here. And I would not be surprised that we do see some erratic behavior for the last hour of today's trading session, maybe some short covering events taking place. And if not, and we have a breakdown, you could make the case that the next key area of support for us is 68.50, and we are actually seeing those puts gaining a little bit of traction when you're looking at the buying volume.
All right. Well, good to know. Thank you so much, Kevin Green. Great to see you this afternoon. Appreciate it. Let's take a look at the bigger picture. Andrew Graham's with us, managing partner, Jackson Square Capital. Thank you for being with us. We were just noting that even though up volume is surpassing down volume, you are feeling like it's super negative today because you're seeing all these tech names down. For example, I was just looking even at Intuit, which is down, almost 7%. So all the Mag 7 names are under pressure. But, is this a buying opportunity type of day? What do you think about this first quarter of trading?
What we've seen so far is a continuation of the December trend, which was towards cyclical value and small cap stocks. This has been the strongest opening for any year of the Russell 2000 versus the NASDAQ 100. So that is going on right now as we speak, and I think that the Mag 7, the tech names are sort of under pressure from sentiment. But as we get into earnings season, as we have to sort of justify the consensus earnings growth on the Russell 2000, which is currently 60%, 60% for 2026, that's, I think, when it's possible that those names will kind of consolidate, they'll hang back, and people will start to reward the real earnings growth, which we feel is within tech and specifically networking equipment.
So, I had a guest on today who liked the small cap values, looking at IWN. But what's interesting here is we've had 3 years of double-digit gains. There's still a lot of big bets on the AI revolution and AI spend. Are you sticking with tech and other sectors? What does your portfolio look like?
We have added some maybe cyclical aspects of tech. So you think of analog semis. So microchip and analog devices are names that we've added recently to the mix. Right? They have a cyclical exposure, of course, within tech. But in terms of like digging deeper into the cyclical exposure, like commodity chemicals and things like that, we haven't seen any evidence that that's the case. You've got a little geopolitical risk premium right now that's building in oil prices, and that clearly helps companies like Dow and Lyondell, which have bumped up here a little bit. They have huge dividend yields, and if you get a real cyclical acceleration, the stocks will double in 9 months. So it's something to pay attention to, but I don't think it's happening yet. And when you look at the U.S. Economic Surprise Index, which is running at +4 or +7, just a month ago it was at 22, +22. So we're going to need to see some more economic surprise in order to justify the rally that we've seen in cyclical stocks. And yeah, it's our preference to get the upside from earnings growth, and that earnings growth, in our opinion, comes from the networking equipment names.
Let's talk about a name like Amazon, which is down 2% today. It's off the $258 high. It's at $237, right? So, $20 off the high. Opportunity here? Why?
Yeah. So Amazon, I think, was up 5% in 2024 and 5% in 2025. It's really been the Mag 7 laggard that really stands out. December's usually a terrible month for Amazon for whatever reason, and January is a really good month for Amazon. You also see a lot of strong consumer trends right now. There's tax cuts, of course, that are going through. You've got other reasons to be bullish about the consumer, the middle income consumer, and maybe lower income consumers. And you've seen it in Wayfair, you've seen it in Etsy and all these other maybe online names, and you haven't quite yet seen it at Amazon. And Amazon has 2 feet, right? We've got one that's in the consumer group, and we've got the other one that's over here in tech. And when they report earnings in February, on February 2nd, I believe, it's going to be about AWS growth. And I think the buy side bar is 21.5% year-over-year growth in AWS. And I suspect they'll get that and a little bit more. Plus, you get the consumer going here. I just think this is the time to own Amazon. I think it's going to be the Mag 7 outperformer, at least for H1 26 for the first half.
And then you looked at a name like Cisco Systems, which people loved for a while. I mean, it was just so great. But lately, it's been in a sell-off. For example, on the 10th or 9th or 10th of January, we were saying how it was down 9 consecutive days. It felt pretty sort of, a moment. You hadn't seen 9 consecutive selling days since 2015. So what happened to Cisco Systems, and why is it now a buying opportunity?
I think the reason to buy Cisco has been coming from the people who are actually installing the equipment, right? Cisco's changed. It's not your mother's Cisco anymore. The company under new leadership has got the right go-to-market strategy. So not only do you have networking equipment for the data center, for the hyperscalers and so forth, and there is a lot of growth there for Cisco. I think the opportunity is in the tech debt that's been amassed within the branch and campus enterprise market. So all these big enterprise companies have all these branches and so on, and all that has been a huge amount of tech debt that needs to be replaced. And there's probably 3 or 4 years beyond when it should be replaced. And when these companies are looking to replace equipment inside the branch networks and campus networks, they're looking to also sort of future-proof, right, the systems. And so the smart switches that Cisco makes have a distributed firewall embedded within them. And I just don't think you could make a firewall single choke point anymore. And there's just been a big, or I guess a good amount of interest from enterprise customers in adopting Cisco's smart switch architecture when they're upgrading their branch and campus networks.
Yeah, and quickly on Arista Networks.
Arista, big beneficiary of scale up in our opinion. So the scale out, we're building more data centers, we're adding more racks and so forth. But in every one of those server racks now, we're connecting them all, we're adding more compute, and that just drives higher connection rates for all the networking equipment names. If you're a switch company, an Ethernet switch company like like Arista, that's enjoyed just big market share gains in hyperscalers and data centers. I think the opportunity here is in scale up is adding more and more. The company has $2.5 billion in deferred revenue that's going to be coming off of the next 18 months. That's a freebie as well. So for us, it's an easy name to own. When we're talking about Cisco and we're talking about Arista, we're trying to talk, stocks that really haven't just taken off in the recent days or in the last 4 months. And there's an opportunity, I think, for greater upside because of that. So we look for earnings growth from Arista to really kick in Q1 of 26, and we expect that to be probably our number one pick, our number one name for this year.
All right, so Arista, a top pick there, Cisco and Amazon, and more discussion there about the big picture. Andrew Graham, managing partner, Jackson Square Capital. Thank you, Andrew. Good to see you. Appreciate it. Coming up next, Options Corner. So we're taking a look at real options trades, options activity on news, Taiwan Semi, Intel, Macy's. We'll be right back.
getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
All right, welcome back to the Watch List. Time for Options Corner. We welcome in Tom White, host of Fast Market here on Schwab Network, taking a look at a market now that's digesting some of the Fed comments in the book, in the beige book, also everything that volatility and a gyrating market here, Tom White. And we're waiting too on earnings from Taiwan Semi. In fact, this week, tell me you found a trade on Taiwan Semi that you're going to share with us here.
Yeah, pulling back just a little bit here, but just over 3% below those all-time highs that we hit just in the last week. So expectations are pretty high. Remember, Taiwan Semi reports monthly sales, so you got a little bit of clarity on what they've already done for the quarter going into this report tomorrow morning. The stock's up about 62% from year-ago levels. Up about 7% so far this month. So the expectations are high. There was an article that came out earlier today out of the information that basically stated that, hey, NVIDIA went to Taiwan Semiconductor, AVGO, some other chip makers went to Taiwan Semi and said, hey, we need to ramp up production. Can you take on more capacity? And they basically said no, according to this report. So that basically tells you that they're maxing out at full capacity here. Now they're trying to build out some infrastructure here in the U.S. Over $165 billion invested already into a couple of their chip plants, but those aren't going to be online for a year and a half, 2 years. So take that into consideration. The option market pricing in going into this report, pretty muted, plus or minus 4% move either way, just under $13 in either direction going into this report. But the bar's high, right? Maybe it should be because there's a lot of demand for their production capabilities as far as the advanced AI chips, CPUs, and smartphone market that's been doing really well. But I did see some bearish, unusual option activity in here today, and this was all the way out in the February monthly option. So not a pure earnings play by this trader. They've got 37 days to expiration. Trader bought over 20,000 of the 330 strike puts in Taiwan Semi. They paid a pretty hefty option premium, $16.55 per put that they bought. So what does that mean? Well, the trader needs the stock to go below 313.45 over the next basically 5 or 6 weeks. And that's about 4% below the current share price. So about that one standard deviation that the option market's pricing in on just a one-day move. So it could be a trader that's speculating to the downside that maybe, hey, this run is over. Maybe it's going to pull back post earnings. Or it could be somebody that's hedging their long stock position that they might have in here. They're paying a pretty hefty option debit. So I would probably allay that it's probably more in the speculative nature where this trader's giving themselves over a month for this trade to work out. But taking a downward stance here in Taiwan ahead of that earnings report tomorrow morning.
Yeah, I can't wait to get that. I mean, there's been so many different stories about chips when we talk about, there was one about chip shortages. Obviously, you have the president working with Intel. There's an NVIDIA story every single day. So waiting to hear what Taiwan Semi has to say tomorrow with the numbers. So thank you for that trade. Now, what about Intel? I just mentioned the president and Intel, which gave it a boost. What do you think about the trade that you found for Intel?
Yeah, it's pushing it back against losses, especially in the tech sector today, up another 2.5, 2.8% today. And that was after 7-8% gains yesterday. I mean, this stock so far this month, Nicole, is up over 30% in the month of January, up over 150% from year-ago levels. I mentioned this one yesterday. We saw unusual option activity in here, call buyers out in the March cycle. And this trade kind of sets up that they're getting out of some of those already and rolling it into the March 60 strike calls. But yeah, a lot of positive commentary on this company over the last several months. The U.S. government taking nearly a 10% stake. NVIDIA investing $5 billion. They got a pretty good price on that one. Those commentary from President Trump that, hey, all these other companies came in after the government said, hey, we're going to take a stake. Intel came to them. He had a good conversation with the CEO of Bhutan recently. So everything seems to be going right for this company, but they need to get their foundry business in order. CPU sales almost after that upgrade yesterday, almost sold out of CPUs for 2026. So that's a positive for this company also. But I did mention in the March monthly cycle, a trader came in today and bought 34,000 of the 60 strike calls, paid an average debit of about $2.26. So that break even where this trader starts to profit is above 62.26 over the next 65 days. So you've got some room, about 28% above the current share price to get above that break even. Now, I mentioned this yesterday. I brought unusual option activity where they were buying the March 55 strike calls. So they sold out of a bunch of those. There was a big open interest position of over 50,000 contracts. They sold 34,000 of those and then bought these March 60 calls. So somebody taking some profits probably and then reallocating some of those funds to a higher strike with the expectations over the next couple of months the stock's going to continue to rocket to the upside.
Yeah, and the shareholders would like to see that because they've certainly had their share of disappointments and seen some volatility, so they would love to see it rocket to the upside. How about we talk about what's going on with Macy's? I know that Bloomingdale's was a bright spot for Macy's. We got it in the retail sales numbers today. Bank of America CEO talked about the resiliency of the consumer spending. What did you find in the trading environment pertaining to Macy's?
Well, yeah, just when I saw the unusual option activity, kind of peak up, I was like, what's going on with Macy's? Why is this stock up about 55% over the last 12 months? Is everybody going back to Macy's? Well, maybe it's reflective of them getting rid of some inventory issues that they had, paying down some of their debt. Maybe some of the competitive nature within the space has gone away, right? They maybe righted the ship. Maybe it's execution at this point. We've seen analysts come out raising price targets recently. Jefferies put a buy rating, $27 price target, while assuming coverage on this one. But it was kind of a head scratcher because if you look back at 2022, 2023, and into 2024, the stock was under some serious pressure due to those headwinds that I mentioned before. But we did see maybe a trader taking a position where maybe this rally that we've seen over the last 12 months is going to get extinguished here because we did see some put buyer in here. And this was out in the February monthly cycle. So you're going to capture that earnings event that comes in February. Trader bought 20,000 of the February 20 strike puts, paid an average debit of only 50 cents. These are cheap options. So the break even where this trader starts to profit below 1950 over the next 37 days. That's about 10% below the current share price in there. Put volume today, Nicole, about 5 times normal daily average volume that we've seen over the last 5 trading sessions. So yeah, this was a head scratcher to me, but maybe the execution's been pretty good. Consumer, you mentioned retail sales came in a little bit above expectations. Atlanta Fed GDP now tracking at 5.3%. So maybe the economy and the consumer is still robust at this point, but this trader betting against any further gains here over the next month or so in Macy's.
I mean, it's been an incredible move for Macy's. It was sort of like if you weren't watching and you rubbed your eyes and you looked and said, what? Macy's is up 50%. But the Bloomingdale spot of it was always a bright spot. The real estate that they had was always a bright spot. But there were plenty of headwinds for a name like Macy's, too. All these department stores, look what's going on with Saks, for example, right? And I mean, Barney's out of business here in New York City. The department store business is not necessarily an easy one. Tom White, thank you so much for being with us, especially with all the smaller, fast fashion type of things that compete with them. All right, coming up, we'll discuss alternatives to your portfolio, different things that you can think about putting in your portfolio.
Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the market. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Peppolides. We're live on the floor of the New York Stock Exchange, checking out every single mover here on Wall Street. Let's talk about Rivian, which is down nearly 9%. UBS downgrading Rivian to sell. The analyst cited elevated expectations for the new R2 launch, for the downgrade. Not great news for Rivian. It's down 8%. Now, Netflix is down more than 2% after the reports have come in that the company is preparing an all-cash bid for Warner Brothers, revising that terms of the $82 billion deal to buy the studio and streaming business. Paramount Skydance has offered $30 a share for Warner Brothers Discovery, but WBD has been rejecting Paramount. Sky will continue to follow the breaking news on that. And we're focusing also on alternatives for your portfolio. And that's why we bring in Kyle Bergacker, Portfolio Manager at Gradient Investments. Thank you so much for being with us. So we shouldn't have the plain old stuff our parents had in our portfolio. All right, Kyle, why not? And what should we have?
Well, thanks for having me back, Nicole. Yeah, I mean, that is the question, right? It really comes down to access to private markets. Providing alternatives is really different than it's ever been, right? You've got a couple legs of the stool now that are very much different than public markets. You think about investing in stocks in the stock market. The private markets have really changed a lot over the last 20 years or so, and very rapidly in the last 2 or 3. It's kind of 3 items. The first is really access, followed by convenience and understanding. So in terms of access, historically, private equity, hedge funds, private credit, infrastructure, real estate, they were really only available to institutions or very wealthy investors, and most individuals simply couldn't participate. Convenience, the old structures were pretty cumbersome. Investors committed capital, $7 to $10 million over years. And then the funds would draw them down in stages. There weren't really any tickerized options for access or perpetual evergreen funds. And once you're invested, the money was locked up. You didn't really have a lot of visibility. And now it's kind of a whole new world. New structures exist, with better transparency. And digital platforms are changing the game. So investors can now access private assets with those blue chip kind of household names, Apollo, Carlyle, Ares, JP Morgan, Goldman Sachs, names like that, among others, through evergreen and perpetual vehicles. And that just didn't exist before.
Right, understand. I mean, you're talking about access, convenience, and also understanding the getting the access to having private equity investments or real estate investments. How do you go about doing that? I mean, do you call your broker and say, I want to look at some
mean, that was the traditional way that people used to do it. And now here at Gradient Investments, we're one of the first to market in providing that turnkey, easy access for the everyday American. We've got an SMA platform, and we partner with Case and Schwab to be able to provide a seamless turnkey access for kind of a fund of funds approach. So if you're looking for growth, we've got access to private equity, to venture capital hedge funds, private credit, and infrastructure, basically the entire alts platform that is now open and accessible to people that it wasn't just a year ago.
Understood. I mean, when you're thinking about people who are younger versus those who are looking at their retirement, the risks and rewards, I mean, how do you do this based on your age?
Yeah, I mean, private assets do have pros and cons, just like public markets. So irrespective of, if you're young or old, on the pro side, it really is providing access to strategies most investors couldn't reach historically. You touched on that at the outset. And with private markets, you earn an illiquidity premium. Essentially, you're being rewarded for being patient. You're paid to wait. And, in conjunction with the pro side, which is different really now than ever, is reporting is a lot simpler with new tools, new managers, where you have 1099 streamlined tax reporting that arrives in time for tax season versus those clunky K1, K3s that are confusing to everybody. So whether you're young or old, those are really positive benefits. On the downside, investments aren't for money you need in the short term. So if you're young and life is happening rapidly, it's coming at you, even with those perpetual or tickerized, those new structures that provide easier access, you typically will face a soft 1-year lockup, meaning kind of a small penalty to unwind that private investment. But after 1 year, quarterly redemption opportunities do exist, and they're available. They're not guaranteed, but they're very, very common. And so usually access to alternatives are best for investors with mid to long-term horizon who are looking for portfolio diversification versus public markets alone.
And so last but not least, as I'm looking at, obviously you were talking about KKR, Apollo, Carlyle, Hamilton Lane, Blackstone, just to name a few. What about just things like the crypto world or commodities? Do you look at that closely?
Yeah, I mean, those are definitely
and do you
part
like
and parcel.
that? Do you recommend that?
Yeah, so I mean, those are part and parcel of a diversified portfolio. It's kind of like cayenne pepper on your meal. You want some, but not the whole thing. So I think we can take a page from large endowments that have been around for hundreds of years. You look at Yale or Harvard, which allocate 20% or more of their portfolios to alternatives, which some of it is the crypto world, but some are private real assets. You think about FedEx, warehouses, privately owned Amazon, data warehouses, OpenAI, Anduril. Think about private companies that get access through these vehicles. So really it comes down to adding diversification, boosting returns through illiquidity premiums, and reducing overall portfolio volatility. I mean, if you compare public versus private markets, over the last 30 years, the S&P has annualized 10% returns with about 17% volatility per year. A buyout private equity fund over that same period, on average, is about 15% annualized returns and about a third less volatility. So that patient capital, that diversification, non-correlated assets in the public markets does pay dividends over the long term.
Understood. All right, Kyle, it's great to speak with you about this type of investing because people like to see some alternatives and diversification in their portfolios, particularly when you have a lot of global events and different things happening. Portfolio manager at Gradient Investments, thank you so much. Coming up next, Kenny Bulgari's at the desk, and he's got a lot of ideas for you in your portfolio. Of course, we're going to talk inflation and earnings, but the stocks he's watching, we'll hear all about it, and we'll be right back.
sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardas and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. Kenny Polcari is with me, partner and chief market strategist at Slate Stone. Well, so glad he's here to give us your thoughts on the market action we're seeing right now.
So look, I'm not necessarily surprised. This churning, this backing and filling, we're not seeing the market collapse, but we are seeing it kind of backing and filling, right? Some of it is just the fact that we've kissed new highs again this week. The S&P made another new high this week. And then we started in earnings season. And earnings season so far has started off great. But there is, I think, some caution ahead. And I think part of that is overall caution in the market, kind of anxiety over midterms, especially in the first half of the year. What happens? Typically, historically, if you look back at the midterm election year, the S&P gives back between 15 and 19% at some point during the year. So investors need to understand that and know that going in, and which is why they should be prepared for that. Make sure they get a portfolio that kind of reflects that action. So I think that's what's going to happen. Look, the banks have started out well, but there's some cautious there. You saw what J.P. Morgan did yesterday, and I think this is a key.
He's always sort of cautious,
Yeah, but
right?
but what J.P. Morgan did, and I always find this very interesting, is they upped their allocation to their loan loss reserve account, which only tells you it's not about losses, current losses, it's about potential losses. And so the fact that they upped it fairly substantially. And so all that says to me is that while he says to you on the one hand the economy is fine, the consumer's great, the fact that they upped the ante in their loan loss reserve account just suggests to me that they're trying to be a little bit cautious. Now, if nothing ever happens and the defaults don't happen, they can take that money and add it back in. But at the moment, I think that's a clear sign. So it's going to be interesting to see I didn't see what Bank of America did today. If they upped their loan loss reserve.
What they did is they beat up on the top bottom
Yes,
line.
I saw
and
that.
Brian Moynihan actually was very bullish on the 2026 economy.
Right.
He said U.S. consumers will keep spending. The loan, I wrote plus 8%, 1.2 trillion. Those are the loans that were given out.
Yeah.
That was not the
That was
reserve.
not loan loss
That's
reserve.
not the reserves.
Yeah.
Deposits were higher. So, I mean, net interest income was on the rise. I mean,
Right.
it was generally a pretty good
Bank of New York
report.
blew it out.
And also gave it a good outlook, too. I mean,
Right.
basically saying good economy.
Right.
So the rest of the bank earnings, we're going to get Goldman Sachs and Morgan Stanley and
Right.
more. Do you think the rest of the banks will continue to be good news?
I saw that Citibank disappointed a little bit. I didn't read the whole story yet, but I think overall the banks are expected to be strong. And so, yes, I think we're going to get positive news out of the banks. Jamie Dimon said the same thing. He actually, what was interesting too out of J.P. Morgan was that they see no rate cut this year and they see a rate hike in 2027. All that suggests is that they're expecting the economy to continue to perform well and then start to overheat, which I think is very interesting because I'm in the camp that that rates are fine right where they are, that we don't need to stimulate this economy by cutting rates at all.
So you have a few names, and I think one of this is about the theme of small and mid caps.
Right.
I was saying that folks who invested in small and mid caps have been so frustrated over the last decade when they're seeing 20% returns. And what happened to my SMID cap, for a decade, right? But you think now's the time.
Yeah, well, listen, it is the theme. A lot of people are talking about small and mid-caps, and we have seen they're lifting their head, and so they're starting to perform well. And so we've got a name we just added to our portfolio is Neurocrine Bioscience, NBIX. It's off about 5% so far year to date. It is it's a little bit of a volatile name because it is a SMID, right? But they're doing all kinds of great work in the neurosciences, so psychological things, anxiety, depression, even brain tumors, and they're making some great progress. So it's a name that we're excited about. It's a name that we just added to our portfolio.
All right, so NBIX, and look, it's
160 is probably, you can look for that right on the chart. I'd have to look at the chart, but yes, it has backed off. It's down about 13% off that high. So
1 month down 12%.
Yeah.
Let's talk about Verizon. I saw 180,000 customers facing some outage today.
Yes.
In the meantime, you do have Verizon as your pick.
Yes.
And Verizon
But it's up
actually
today.
one of the names that was in the green. I saw Telecom. I saw AT&T and Verizon had green arrows when there was a sea of red, I should say.
Right.
But this chart, though, is as flat as flat can be.
Well, but if you look at the chart, how far does this chart go?
It's a 1 year.
It's a 1 year chart. Well, Verizon trades in a very narrow range, like 36, 46. That's where it trades. And where's it trading right now? 38?
Right now, 39.70.
Yeah. So it traded down to 36. It kind of bounced off there, and it's trading back up. But look, the story about Verizon, it's a 7% divvy payer, right? It's consistent.
That's why our dads picked it.
That's exactly right. And so if you are worried about some chaos in the markets, and you want exposure, and you want a place you want a stock that's going to pay you, Verizon is always my go-to pick. I own it. The firm owns it. I'd buy more on this pullback. We bought more of it, and so that's just a safe thing. There's nothing sexy about it. It's just a safe play in kind of an uncertain world.
And then we talk about aerospace and defense.
Right.
The president's administration wants to add another, 500. We're going to get up to 1.5 trillion. Right? So tell me about L3Harris.
So L3Harris again is smack in the middle of that. Now there's just new news that came out yesterday, I believe it was. NVIDIA made. The country made the Department of Defense made a $1 billion investment in their missile. It's going to be a new company that they're going to spin off. I forget what it's called, missile something. It's going to spin off sometime later this year. But the Department of Defense just made a $1 billion investment into this part of L3Harris. You can see the stock's reacting very nicely. It's actually trading, in a straight line up over the last couple of days ever since that news came out. But look, if you're worried about geopolitical issues, which clearly everywhere you look, there's a geopolitical issue around the globe, right? Whether it's Iran, it's Venezuela, it's Cuba, it's Russia, it's Ukraine. Aerospace and defense is going to be another sector that that I would overweight. And L3Harris is one of the names I picked. Right there.
What are your favorites in the Mag 7?
My favorites in the Mag 7 are going to be Amazon, because that underperformed last year. Amazon, NVIDIA still. Google is going to be, I don't own Google. It's funny, I missed that boat in Google from the very beginning. But Google now is suddenly piquing my interest a little bit.
Probably a good category,
Yeah, but I think, listen, it's not about getting out of the Mag 7 at all or getting out of tech. You have to have tech in your portfolio because that story is not going away. The AI story is not going away. So it's just about when do you get into it? When do you add to it? If you already own it, you're going to participate. If you don't own it, you got to get in. Then you got to get in slowly. You got to get in just kind of dollar cost average for a little bit until you get a sense of where this market's going and where they're going. Because look, if the market pulls back, tech will be the first one to get hit because it is so outperformed. So you just have to go in kind of with your eyes open.
All right, Kenny Bulgari, Slate Stonewall, thank you so much for being here.
Well, thank you for having me. It's always a pleasure.
A nice variety there. Welcome back to New York for a brief moment. Thank you, Kenny. Coming up, our panel ready to talk all about the retail sales data and the state of the consumer. Are you spending or are you pinching the purse? We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, or even retiring. You can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Bartis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Let's dive into those retail sales numbers that we got in today. A little better than expected. You also heard Brian Moynihan from Bank of America really counting on the consumer to spend in 2026. And we have right now with me Anthony Ferry, CEO of Wavia, and Brian Jacobson, Chief Economist, Annex Wealth Management. Anthony, Brian, I'm so glad you're both here. Anthony, your thoughts on retail sales and where you think the consumer will spend or won't spend in this first quarter of this year?
The results of the report weren't too surprising for us. I think continued spending and cautionary spending from the consumer is going to continue. We do see a lot of uncertainty in the market, and trading down continues, at least with our data. And the consumers looking for those bargains and being responsible with their spending. I think that the holiday season was strong. We see even up to the current data for ours is that spending continued, and all the uncertainty in the market, they're overcoming it. And the traditional sales trends with car purchasing towards the end of the year, we saw strong consumer electronic spending leading up to the Super Bowl, which we always see. The Black Friday sales is a big spike for television sales. So I think that we're going to continue the same trends, but continued trade down and those necessity products, those need-to-haves more so than the want-to-haves, continuing into the concerns in the start of the year with all of the other uncertainty around the market that's influencing consumers.
Talk about the holidays, and there's always this worry that we're not going to see the growth, and there are all the different sort of estimates. And it always comes in at 3, 4, 5% year-over-year growth, and people are shopping online. You mentioned televisions and things like that, maybe other big-ticket items. Brian, were you watching tariffs and how people were spending?
Yeah, I think that it did really show up in those numbers, how we saw over the last 12 months that there was a decline in some of those big ticket items as far as with autos, furniture, things like that, that you had an increase in price with the tariffs, but you also see some of that demand destruction because there was a decline in those purchases and those big ticket items. And while the month of November, keep in mind, this retail sales report was from way back in November, it was slightly better than expected on the month, but that longer arc is still showing that the consumer, maybe what they did was spend a little bit less going into the holidays so they could look for the bargains and buy some of those essentials during the holiday shopping season. In fact, the Beige Book came out just about an hour ago to give some clarity as to maybe what happened and how to interpret it. High-income individuals were really driving a lot of the spending, especially travel, tourism, things like that, whereas low to moderate income households, they're still feeling the pinch. They are price sensitive and really focusing more on essentials and looking for bargains.
Brian, you mentioned tax refunds in your notes. Tell me more about that.
That is one of the things that I think maybe can help bridge the gap between a delay between when we see the GDP growth increasing and the labor market beginning to recuperate here is tax refund season. We know that because of the One Big Beautiful Bill Act, that this tax refund season, which is basically January through April, a lot of it is going to happen in February. It's going to be a record, probably about $200 billion. And a lot of that will go towards lower and moderate income households. As a result, maybe that can bridge that gap between some of the sluggishness that we see now in the labor market and then a re-acceleration as we get into spring and through summer.
Yeah, and Anthony, in your notes, you were talking about some of the hot-selling items. You mentioned televisions, right? Smart TVs, gaming consoles, also according to Wavia's data that you brought to us. I appreciate that. And how are people using buy now, pay later?
Yeah, we're seeing an all-time high in buy now, pay later. So again, goes to an indication indication of consumer sentiment that they're being cautious. They don't want to be out that cash all at once, and so opportunities that they have to be a little bit more conservative and stretch the spending dollar, they're taking advantage of. So again, buy now, pay later is at an all-time high that we've ever seen. The console spike sort of goes hand in hand with the TV purchasing being driven a lot again. I think by Black Friday and leading up to everybody wanting to purchase for the Super Bowl is always a big one. Console, Nintendo released new Switch console that drives quite a spike too. In our data, we're pretty heavy in the consumer electronics space, so we have pretty good data in that as well. So yeah, those are typically strong spaces, but we did have a release in that in the console market that drove that a little bit. Without that, who knows where that would have fallen. But again, same consumer concerns with spending, looking for those bargains and taking advantage when they're there.
When we think about, are people looking for bargains or how they'll be spending? Are they worried about their jobs or their credit card interest rate levels? A final thought here, Brian.
Yeah, it's really timely that we got that announcement from President Trump that he wanted to cap interest rates on credit cards at 10%. I mean, if buy now, pay later is at record highs, that's just going to keep climbing as people lose access to credit or those credit lines get cut if we do see that type of interest rate cap put into place. And so, in terms of the access, the ability to spend, to bridge that gap from paycheck to paycheck could be severely crimped if we do see some of these policies.
Yeah, it was interesting how Brian Moynihan said that people are spending, but also that small businesses are feeling optimistic because consumers are spending. I guess they feel confident enough to do these buy now, pay laters, like you said at Wavia. They're really using that. Anthony Ferry, Brian Jacobson, great to see you both. Really appreciate it. I'm Nicole Petalides. Thanks for being with me every single day here on Schwab Network at 9 a.m. and also at 2 p.m. every day. Thanks for being with me. I'm Nicole Petalides, and coming up next is Market on Close. We'll be right back.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
predict what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Good afternoon. Happy Wednesday to you. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden coming to you live from our Chicago headquarters.
And I'm Pam Barton coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll discuss how volatility has returned in 2026 and talk about ways to diversify your portfolio to help protect you from that. Later, we'll look at NVIDIA and Google and break down their place in the AI race. And we'll dive into the world of alcohol and talk about how dry January impacts beverage stocks and why overall alcohol consumption has been trending lower. But for now, Marley, take us through what you're watching today.
Shares of Wells Fargo, Sam, fell by the most in 6 months today after missing analyst profit estimates as severance costs drove up expenses. Net interest income and net income both came in slightly below expectations as well, sending the stock down more than 5%. Bank of America also moving lower after earnings, despite a fourth quarter beat on both profit and revenue, driven by stronger net interest income and equities trading. Investors appear to be focusing on softer fixed income trading results and have questions about how much momentum can carry into 2026, even as the bank guided for 5 to 7% net interest income growth next year. And Rivian under pressure as well today after getting its second downgrade this week. UBS downgraded the electric car maker to sell from neutral, saying the stock has gone too far too fast. The firm is also concerned that expectations for R2 SUV sales might be too high. We'll dive into these stories shortly, but first let's take a look at where the markets stand as we head into the end of our trading day. We are a mixed picture here. The S&P trading down 0.9% at 69.01. The Nasdaq down more than 1.5%, 25,315. On the Dow, we're down about 1/3%, shed 187 points down to 49,000. And the Russell, though, has found its way back into the green, up 1/3% at 26,4207. As we take a look at our 10-year here, we're down to 414. The dollar unchanged at 98.90. Gold is higher, another record there, 46.70, up 1%. Crude oil higher as well, 62.23 a barrel. And Bitcoin heading up towards that 100,000 level, up almost 3% today, 97,475. Sam, that is the highest we've seen Bitcoin go in weeks. What's catching your eye today?
Yeah, looking at some of those crypto-related stocks as well. We're having a nice day off the back of this too, but I'm looking at the data flowing again. Obviously, we've been watching the backlog trickling through. So we've got the producer prices ticking up in November, more than expected year over year, but less than expected month over month. That core PPI, which strips out trade services, rising at 3.5%. So it was a bit of a mixed read. The final demand goods were up 0.9%. So that's something to keep an eye on, as goods inflation can sometimes lead to services inflation over time. Retail sales, we also got those showing the consumer is holding up and still spending. The November print coming in at 0.6% month over month, which was more than the market expected and was broad-based across various categories like cars, gas stations, and sporting goods. Now, the control group, which strips out the volatile components, rose 0.4%. That was in line with expectations, and that's important because this flows into how GDP is calculated. And so, as KG pointed out this morning, this could be a positive and should re-rate GDP estimates a bit higher. Now, this data, remembering, is for November, as the BLS is still playing catch-up after the government shutdown. So the numbers are still lagging, which may be why we haven't seen a huge movement as far as the market reaction is concerned. If you take a look at the Treasury market, for instance, we've seen the 10-year yield really staying range-bound. So for now, the next Fed meeting is likely to
to be another wait and see. Marley, I'll send things back over to you with Jenny in Chicago with some of today's top movers.
Thanks so much, Sam. Like you said, Jenny Horn, co-host of Next Gen Investing, joining us here in our Chicago headquarters to talk about some of the big moves we've seen today. Of course, we have to talk about bank stocks to start. We got earnings this morning. Let's kick things off with Bank of America. You know, they had a good quarter, but we are seeing a move to the downside of almost about 4%.
Yeah, and I think right now the looming concerns over the credit environment in the United States is really just dominating these post-earnings moves. I mean, we've seen now consistently pretty substantial earnings beats, and Bank of America no exception. Beat on earnings and revenue, powered by what they highlighted was strong net interest income and record trading performance. But, however, now seeing a theme, weak investment banking and this looming regulatory and rate risk dragging on shares today, even as management remained fairly upbeat about the 2026 economic outlook. So we did see that earnings per share, again, top estimates, net interest income rose 12% year over year, or excuse me, that was 9.7% year over year. Net income was up 12% year over year. But management now forecasting another 5 to 7% growth in net interest income growth in 2026, continuing again some overall strength. Equity trading revenues was up 23% year over year, hitting an all-time high in their fourth quarter. And overall sales and trading revenues were still up about 10% year over year. That was the 15th straight quarter of growth. Now, investment banking lagged, and so we saw investment banking fees flat. Equity underwriting was down 20%. And this is right now perhaps being read as a broader scope on deal making that could slow into this new year. But regulatory risks definitely still remain, I think, the most central concern, at least for the near term. Of course, the proposed 10% credit card cap rate could significantly cut Bank of America as well as the broader financial system's profits if implemented. And so we know CEO Brian Moynihan said consumer and business trends actually, frankly, remains very strong. They're bullish on the U.S. economy in 2026, but that was not enough to ignite any upside here. We're down 4% today, which these are pretty substantial moves. If you look at the chart, I mean, it's a pretty big red candle for a name that doesn't typically trade this much volatility.
Yeah, and interesting, you know, a lot of the question was around the impressive year that bank stocks financials had in 25, and could they sustain that? These numbers indicate they are sustaining it. They just seemingly weren't good enough is sort of the message that I've been hearing in conversations today. And again, that's why we're down now about 3.75% for Bank of America. Even bigger dip off for Wells Fargo, though. They had some pretty significant severance costs that drove up their expenses for the quarter.
Yes, and so that's also, I think, interesting, as well as the fact that Wells Fargo, I mean, still, again, seeing their overall income missing some of their forecasts, but net income at the bank was around $5.4 billion in the fourth quarter. That amounted to roughly $1.62 a share. That came in below expectations. Revenue 4% higher, but higher loan balances did help lift their net interest income. But they expect net interest income to now rise in this new year, boosted in part by a growing balance sheet and assuming that the Fed does cut interest rates at least 2 to 3 times. But this was the second quarter that they were free from the asset cap that the Federal Reserve did put into place back in 2018 as a punishment for, of course, that fake account scandal. But the bank did take roughly $612 million in severance charges, and also mentioned that AI, I'm explicitly stating this, that AI is going to change right now their headcount. And you haven't seen it called out specifically, and you have from actually both Bank of America and Wells Fargo. But I do think that you look at right now the rising expenses for the banks, and frankly, headcount was one of them. And it was actually very similarly mentioned at Delta Airlines, a very different company, but I'll be curious to know if this is a theme we see emerge where it's the call out of specific weakening labor force as a result of the presence of AI. Now, Wells, of course, in the way to differentiate it from the other big banks is you look at right now at the exposure like Bank of America has. It's diversified across so many businesses. It's, I mean, really just has its hand in everything financial, where Wells, primarily a more U.S. and really commercial-focused bank. And so for that reason, there's also being read through as perhaps a bit more exposure to if we see this overall situation, of course, the cap implemented, it could perhaps sway a bit more on Wells Fargo, some of the analyst commentaries I saw today. But again, we're all hypothesizing on a situation that we could still see evolve in the next 6 or so days.
And certainly, with that announcement, even prior to it, looking for any signs of credit stress was a big focus of investors in all of these reports, and they do seem to largely be holding up. Now, what's looming is any determination on that January 20th date for this potential cap and what it would mean for borrowers for these big banks. But Wells Fargo down more than 4.5% the H200 shipments to China. It's not a huge update, but an update nonetheless. And we are seeing NVIDIA shares down pretty significantly today for NVIDIA.
Yeah, and if you look at the heat map today, I think it illustrates exactly why markets are lower. I know that we're giving a lot of blame to the banks. I mean, look no further than big tech. And NVIDIA could be continuing to face this resistance as a result of reports surfacing that their H200 chips are still being restricted in China. This is right now going to, I think, be a pretty critical story going forward still for NVIDIA, as we got reports from Reuters. Chinese customs authorities reportedly told customs agents this week that their H200 chips are not permitted to enter the country. Officials have warned companies to not buy the chips unless absolutely necessary, but it does come after the Trump administration, of course, did recently formally approve the H200 chips for export to China under certain conditions. And despite that approval, it's going to be the back and forth I think that we'll continue to see from China then basically responding by blocking the chips at the border. Now, analysts do believe in Beijing may be trying to gain some leverage. I think that's all this really frankly is. But if NVIDIA were to allow that fully into the Chinese market, it would represent a pretty major financial win, not just for the company, but also for the U.S. government, who does collect now a 25% fee on those chip sales. So it's not, of course, expected, but I do think that anytime you see snags in that narrative being smoothed out, it not only gives weakness to tech, which is now the pawn in this geopolitical frenzy, but it also does, I think, then just signal the fact that there was a lot of bullish enthusiasm tied to an expectation this situation would get resolved. Doesn't seem like, especially from the reports we got today, that China, of course, was going after cybersecurity, that we're seeing a resolution as soon as perhaps the street will want it.
We are seeing a lot of levers being pulled in this ongoing story here. Another one that stuck out to me is that the U.S. saying that China cannot receive more than 50% of the total amount of chips sold to American customers. So even a sort of internal cap that may be hard to track, in fact, as those numbers will change regularly. But NVIDIA under some pressure today, down about almost 2%, about 1.9%. Lastly, let's talk about Intuitive Surgical. They did a preliminary release of their fourth quarter results. It's not their earnings report. Their earnings report is coming, but it's not being well received.
It's not. And so this name, I will say that to its credit, we had such expectations for its Da Vinci system that you look at its earnings, previous earnings report, we saw a huge spike tied to everything related to Da Vinci. Now today, giving back a lot of that strength on really the fact that their preliminary fourth quarter results and full year 2025 results were a bit lackluster. So they noted expanding procedures, higher system placements, and revenue gains still. But procedural expansion was definitely still notable. We saw worldwide procedures using Da Vinci and Ion systems rose about 18% versus last year. Da Vinci specifically, those procedures rose 17%, while Ion procedures jumped about 44%. And in 2025 overall, combined procedures did increase approximately 19% versus the year prior. But for the full year, they do right now expect roughly around $10 billion in revenue. That was an increase of roughly 21%, again, from 2024, driven by these increased system placements. But preliminary instruments and accessories also were higher. But again, all of this, we said there was so much riding on this growth really relating to all of their Da Vinci systems. And I know Ion also was a huge driver of growth. You see some of these numbers and it's like, where was the miss? But I think it was that so much really was priced into these forward-looking expectations that now the delivery of that was not as optimistic as the street had been hoping for. So we're down 3%. We've actually eased off of some of the lows of the day, but now pulling back, I mean, pretty substantially on the week and down about 11% from highs. I will say that all three of our prior names that we just looked at have been at least near all-time highs in the last several months. This name has not seen highs since last January. So this was not the catalyst they needed, but I think Da Vinci is just like reading this press release, it's the most amazing form of utilizing AI. These like basically minimally invasive procedures that have like no error rate at this point. That is still, I think, fully intact. It just a lot of expectations were riding on these numbers. Now perhaps we're pricing that in for their actual fourth quarter report.
It will be interesting to see on January 22nd when they report how much of a reaction we see, as they already got quite a pretty substantial preview to some of those numbers, the ones that it certainly could have moved them to the downside. Jenny, we appreciate you being with us to break that down. That's Jenny Horn, co-host of Next Gen Investing. And I do want to send it back to Sam in New York to find out what we have coming up for the rest of the show.
Well, Molly, we'll talk the return of volatility in 2026 and discuss how to diversify your portfolio for the new year. Market on close. We'll be right back.
insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is The Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Bartis on the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. Let's just check in with where the market stands right now because we've seen a mostly risk-off tone, although it's not red across the board. We've got the Russell 2000 outperforming here, and if you take a look at some of the sectors, we have seen very much a degree of a rotation here when you take a look at the utilities, energy, and healthcare, which have been higher. Obviously, we are tracking at some of the energy stocks as well that are up against the higher prices that we've seen given the geopolitical cross currents. We've also seen a very, very nice day for Bitcoin as well as it approaches that 100,000 mark too, and that's bringing along some of the crypto-related names with it as well. So we have seen very much the S&P 500, the NASDAQ, and the Dow coming off those records that we'd seen earlier in the week, over the last couple of weeks, in fact, and we have got technology very much under pressure. In fact, most of the Mag 7 in the red today, so that is weighing down on the NASDAQ as we see this broadening out away from some of the high-flying tech names in the market to some other parts of the market. And of course, we did get a lot of information this morning. We've got the flow of data happening again. We've got the retail sales, which shows the consumer is holding up okay, and then the PPI, the producer or wholesale prices as they're called, showing a little bit of a mixed picture. Nothing that seems to scream alarm bells, but certainly something to keep an eye on as that does remain somewhat elevated, picking up on both month-on-month and a year-over-year basis. Now, the US dollar is at 98 right now. The DXY, crude oil, as I mentioned, taking a bit of breather actually. It touched 61. We're at $60 a barrel right now. As I said, Bitcoin seems to be a big story that's getting a lot of attention right now, sitting up over 3%. We're at levels of 97,000 and change. Remember, the narrative for the last couple of months has been the fact that it just can't get past 90, but we have seen that very much catching a bid as far as the cryptocurrency is concerned, and that very much is part of this rotation theme that we're talking about. The 10-year yield at 4.15, even though we've seen that coming off a couple of basis points, just remember, it is still trading within that sort of range that we've been stuck in for quite a number of months, actually, despite the fact that obviously we've had a lot of updates with respect to the power probe this week and also some of the data. But for now, the markets seem to think that the next Fed meeting is wait and see. Technology is very much under pressure, down almost 2%, and so is consumer discretionary. So that's really where the drag is coming from today. All your sort of usual suspects, we were naming a couple of those Mag 7 members as well. Some of the stories that's weighing on sentiment today, particularly with some of the China headline risk associated with some of the technology names, particularly in software, cybersecurity. It's been a bad week for software. We continue to see, obviously, the sell-off accelerating. They got smashed yesterday. We continue to see these under pressure today as well. Com services down 410. Staples up, which we typically see that in this kind of environment, 1.2% higher. And if we take a look at some of the other sectors on the move, as I mentioned, utilities and AI adjacent type trade up 0.9, real estate up 0.7%. We did get some housing data out this morning. It continues to look encouraging, particularly as the mortgage rates are coming down. Materials on the line to the upside, industrials are just fractionally lower. They've been really catching a bid lately as well as part of that broadening out story here, of course, with some of the mixed bag of earnings that we've been getting. And, of course, we look towards Goldman, Morgan Stanley as well, see what they're doing. But some of the credit card news has been weighing on these names. Energy higher, as I mentioned, tracking the oil prices, and healthcare having a bid today at 0.5% there. Didn't mean to scare you. All right, let's bring Marley back into the conversation and welcome in our next guest, Jason Blackwell, Chief Investment Strategist, Focus Partners Wealth. Very good afternoon to you, Jason. Thanks so much for joining us. So we've seen the return of volatility, and you say this was expected, particularly around the political and policy noise. But, I mean, did you expect to see the market sort of vacillating between the policy announcements that we've been getting over the last couple of weeks? I mean, particularly when you look at Truth Social, some of obviously the president's announcements, particularly when you look at what's been happening as far as foreign policy, the geopolitics is concerned, what's happening over in Iran right now. Is some of this on your bingo card?
Yeah, I think this is actually right in line with what we were talking about with investors to expect in 2026. Anytime you enter into a midterm election year, what you start to see is politicians start issuing out their trial balloons of what are going to be the stories that were going to help their party secure the election for the midterms. I think that's part of what we're seeing here is we're going to see a lot of policy balloons, some of them geopolitical, some of them things like the credit card fees, where they're doing a bit of A/B testing in terms of what works and what gets their bases moving. What we see historically is these midterm years, they tend to have the biggest drawdowns. They also tend to have the biggest recoveries, and it's because a lot of these policies they get thrown out there as ideas. They don't actually make it through Congress. They don't actually become law, and the market tends to recover pretty quickly from them.
So, Jason, if several of these policy proposals don't actually materialize, how should investors think about these headlines and react to them without getting whipsawed?
I think the avoiding the whipsaw is just not getting yourself whipsawed, and that means looking through a lot of the noise that's coming out of Washington, looking through a lot of the noise that's coming out of the other parts of the leadership, and really focus on where is the cash flow today or in the future, and being very careful to keep very long-term focused and not allowing yourself to get emotional or overly driven by the policy announcements.
So, Jason, if it's the case, and I've heard other people talking about this today as well with respect to this flurry of headlines, throwing spaghetti at the wall and waiting to see what sticks type of mentality, what do you make of the broadening out that we've seen in this market? This degree of rotation where it's not necessarily red across the board. In fact, there are pockets of this market which are holding up quite well. I mean, you look at Bitcoin today, you look at oil and energy off the back of some of the Venezuela and Iran headlines as well. I mean, you've got utilities up as well, materials and industrials are been performing quite well. I mean, can we get to 750, 8K, as some have been throwing out there, with this kind of momentum, or do we really need the Max 7 to start pulling their weight again?
I think it's pretty hard to get to those higher numbers without the Mag 7 doing some of the lift. But the other theme that we've been talking about for the last year or so has been this idea that AI leaves the Mag 7, and it really becomes a driver in other businesses. I was listening to the previous segment talking about bank earnings and the potential impacts on employment. I think that's something that we're very much looking for as investors is where does AI leave from being that proof of concept, that pilot program, and actually start to drive earnings. And I think what we're expecting to see, and I think what investors are expecting to see is that should start to roll over in 2026. And so you can see a bit more of that broadening out. Remember back to almost this time last year, the announcement of DeepSeek came out. All of a sudden, it looked like AI was going to be cheaper. Maybe you didn't need the best chip. Maybe you didn't need the best AI. What did you see outperform? You saw international outperform. You saw industrials outperform. You saw healthcare. It was these businesses that are really hoping to leverage AI for their core business rather than the manufacturers themselves.
So, Jason, as we see this sort of AI, move from hype to actual execution here, and that will establish who the winners and the losers are, knowing we need